All right, let's get into it. Today, we're diving deep into a company you've probably never heard of, in an industry you almost definitely interact with every single day: coffee. We're taking a close look at Coffee Holding Company, ticker symbol JVA, based on a fantastic analysis from Save Invest Compound. And that really brings us to the big question we're trying to answer here. Is this little-known company a hidden gem, a real diamond in the rough for investors? Or is it a classic value trap? A stock that looks cheap for some very, very good reasons. Let's find out. Okay, so first things first, we need to get a handle on the fundamentals. What does this company actually do, and what do the initial numbers tell us right off the bat? Now, the first thing you need to know is, don't think Starbucks. JVA is not a consumer brand you'd recognize. They're a roaster and a wholesaler, mostly for private label clients. What that means is their success is chained directly to the price of coffee beans, which is super volatile, and how efficient they are. It's not about brand loyalty. They're basically a middleman, and that's a tough spot to be in. But right away, you see numbers that would make any value investor lean in. The analyst's discounted cash flow calculation, that's a way of estimating a company's true worth, pegs the value at around $6.20 a share. At the time of the analysis, though, the market was only asking $4.64. And that gap, that's the good stuff. That's what we call the margin of safety. So what's a margin of safety? Think of it as your built-in cushion. It's the gap between what you think a stock is really worth and the price you actually pay for it. The bigger that cushion, the more room there is for things to go a little bit wrong without you losing your shirt. It's absolutely crucial. So on the surface, that discount looks pretty appealing, right? But a cheap price doesn't automatically mean a good deal. To figure that out, we have to dig a lot deeper into the company's real strengths and its weaknesses. And bam, this quote from the analysis really gets to the heart of the issue. JVA lacks a moat. That durable competitive advantage that protects a business. For them, it means their customers can just up and leave for a competitor pretty easily. That gives JVA almost zero pricing power. This right here paints such a fascinating picture. It's a total tale of two stories. On one hand, you have a rock-solid balance sheet. The company has plenty of cash and very little debt. It could definitely weather a storm. But then you look at the other side, and its profitability is just weak. We're talking razor-thin margins under 2%. So it's stable, sure, but it's not exactly a high-powered profit machine. So if we do a quick scan for red flags, a few things really pop out. That lack of a moat we just talked about is a big one. Then you've got the low margins, the constant wild swings in coffee bean prices, and of course, a ton of competition from much, much bigger companies. Okay, so you've got this strange mix, right? Strong finances, but a kind of weak business model. How in the world do you weigh those against each other? Well, what's really interesting is how the analyst provides a framework to do exactly that, putting actual numbers to these more abstract ideas. This is a weighted SWOT analysis, so the analyst scores the strengths, weaknesses, opportunities, and threats, and then weights them by how important they are. The final score comes out to 5.2 out of 10. What that number is basically telling us is that for every positive, there's a nearly equal negative pulling it right back down. It's a numerical way of saying the company is kind of stuck in neutral. And this chart helps us visualize the range of what could happen. In a bear case, where things go poorly, the company might only be worth $4.50. The base case, if things just kind of chug along, is $6. And in an optimistic bull case, maybe the value gets up to $7.50. This really shows you the potential upside, but it also grounds you in the downside risk. So, to put a hard number on that downside, the analyst gives JVA a risk score of 5.8 out of 10. That's a pretty moderate risk profile, and it's driven mostly by that weak competitive position and those unstable profits. And on the flip side, the opportunity score is 6.2 out of 10. See the pattern here? It's all very middle of the road. It tells us there's some potential for things to go right, but it's not screaming that this is some kind of once-in-a-lifetime opportunity. So, after all that digging, what's the bottom line? Let's translate all of this analysis into an actual strategy by looking at some specific price targets. Now, this is really interesting. Let's say the goal is to make a 9% return per year. This table shows how the price you can afford to pay today changes based on how long you plan to hold the stock. And notice, the longer your time horizon, the lower your entry price needs to be to hit that 9% target. For a 16-year hold, you'd need to get in below $4.40. This table just flips the script a bit. It shows that if you're willing to accept a lower return, say just 5%, you can pay a bit more to get in, up to $5.50. But to hit a more ambitious 10% return, you have to be super disciplined and wait for a price around $4.10. In any scenario, the potential sell target is hovering around that $7.50 mark. So what's the big takeaway? The analyst really boils it all down to this one powerful sentence. Coffee Holding Company is a modestly undervalued but low-quality business. In other words, yeah, it's cheap, but it's probably cheap for a reason. And that leads us to the final actionable conclusion. For anyone who might already own the stock, the verdict is to hold. For anyone thinking about jumping in, it's a cautious buy, but only if that price drops below the key level of $4.40. That's the magic number where the margin of safety might finally be big enough to make up for the company's weaknesses. So ultimately, JVA is a perfect case study in the difference between price and value. The price might look tempting, but the quality of the underlying business just isn't that strong. It's a great lesson for any investor. So, what do you think? And more importantly, which company should we put under the microscope next? Let us know in the comments below.